Hello everyone, thank you for tuning into OptionGig, and this is your host Vivek, and I come here to present you the summary for the week starting from 24th of February to 28th of February. What a week it was, and we will get into the details after this introductory music. Hello everyone, welcome to OptionGig. This is your host Vivek, part-time option trader and full-time worker, husband and father. If you also want to generate consistent monthly income trading options while working in your regular day job, then join me in this journey. Let's get into the details. As always, let's first look at market moving news, and we know that news fairy was very busy last week, but the biggest news is coronavirus cases coming from outside of China. There were a large number of cases reported in South Korea, Italy, Switzerland. A fashion show in Paris was cancelled because of the fear. And on Friday last week, the first death related to coronavirus was reported in US, and that spooked the whole market. As you can see in this one, cases reported in Iran, South Korea, Japan, Italy, and US. And because of all this, there was a meltdown in US equities market. Totally, companies lost 3.6 trillion of market capitalizations. Most of the indices were down between 10 to 11%. Everything, technology, S&P, all broad market indices. I think being down 10% in a year is nothing new, but what caught everyone by surprise was the pace, was the speed at which the market collapsed. And as you can see, this was an unprecedented speed. So this chart represents a 10% correction from the peak and how many days it took to correct from that peak. As you can see here, at the very end, this is a February 2020 correction. Never happened so fast in the history before. And that's what spooked the whole markets. Right, so like I said, here's a summary of market indices. Everything in red. S&P 500 based in ETF SPY was down almost 9%. It opened at 323.14 and closed at 296.26. Dow Jones, nothing better. It was down 10.12%, opening at 280.33 and closing at 254.56. The technology sector ETF QQQ did a little better as compared to S&P 500 and Dow Jones Index, but it was also down approximately 7.79%, opening at 221.84 and closed at 205.80. Lastly, the small cap index IWM ETF opened at 161.86 and closed at 146.33, a change of 10.61% down. So there was red painted all over the market indices. The pace, it was just 1 week. What a difference just a week can make. We all witnessed that in last week. How did we do? A quick summary of my trades. In total, I closed 25 trades, and that includes the trades that I closed for loss. That includes the trade that I had to roll out, means I closed it for the current month and rolled it out to future month. Out of those 25 trades that I closed, 18 were profitable and 7 were losing trades. That gives us a winning ratio of 72%. Looking at the carnage that happened last week in the market, 72%, I think I'll be satisfied with that. It's been a little lower than what we have usually seen in the previous weeks, but I think it is nothing to sneeze at, 72%. And 64 trades we opened last week. Pretty busy week for us for two reasons. Number one, the March expiration was getting closer and closer to 21 days to expiry. So anyway, we had to roll it. Secondly, the whole market downturn also enabled us, or forced us rather, to put on a lot of our hedge trades. So we had to add additional trades as our hedge trades on the positions that were challenged. So we rolled out a bunch of trades, we added hedge trades, and then we, opportunistically also we put on a few trades because the volatility was super high, and we know volatility is our edge, but we were very opportunistic in picking and choosing the trades that we wanted to put. Okay, so we will see in terms of the top 3 trades. As always, we see it in the weekly updates. But before we get into the trades, let's talk about the thought of the week. And given what had happened in the market last week, I thought it is appropriate for us to talk, what did we learn from the $3.6 trillion? It was really a wake-up call for those investors or traders who have recently entered into the stock market, who have never seen a big downturn in the market because the market has been in a bullish uptrend for almost 11 years. So this 3.6 trillion wake-up call really jolted many of those fellows from the deep sleep, and people were caught unawares. They were caught holding positions which went very much against them. So few lessons that we learned, and I have covered these lessons in a detail in my YouTube video. You can find the link here, and I will also add the link in the notes for this video. I did a separate YouTube video talking in details of what lessons did we learn, but here I will quickly summarize it. Few lessons that we learned, or the things that if we had followed, we wouldn't have been hurt as bad as other people. Number 1, position sizing. I will talk ad nauseum about how important the position sizing is for an option trader. I never violate the 5 to 7% rule, but if you were too big in a position sizing, it would have kept you awake in the night in last week. Very important position sizing. Number 2, I want to talk about the lesson that we learned is how important your portfolio diversification is. And when I talk about a diversification, it's not only related to what type of assets you own in terms of what type of stocks you own. Of course, you should be diversified in terms of the stocks and the ETFs that you own. Have a lot of positions in uncorrelated ETFs or stocks. For example, you should have a mix of momentum stocks, bonds, precious metals, etc. Because if you see, most of the stocks went down, but the bonds rallied. So if you had a mix of these positions, even though you were hurt on the momentum stock side, but you would have compensated something on the bond side with it. So allocation of assets, what type of assets or you own is important. But as an option trader, a few other things which are important are what about direction? So diversification of your directional trade. If most of your trades were bullish, it was a bad week for you. But if you had a mix of bullish, neutral, and bearish trade, you did okay. You were hurt for sure, but not really as bad as if you only had bullish trades. So mixing the strategy, diversification of strategy is important. Also important is diversification of the option trading strategies. For example, if you only had undefined risk trades, you would have received a margin call by now, because the type of movement that we saw in the broad market means you need to have a lot more buying power to hold those positions. But if you had a mix of defined risk and undefined risk, probably you would have done a little better. So when I talk about diversification, it means it is important to have the asset allocation diversification, the directional diversification, as well as the option trading strategy diversification. Third lesson that we learned is the importance of overall portfolio allocation and the importance of having cash in it. As I've said multiple times, you should be investing not more than 50 to 60% of your overall investable amount in option trading. Keep the rest in cash. And the reason why we keep rest in cash is to safely navigate the situation that happened last week. If you have had money sitting on the cash, it would have allowed you to avoid margin calls. Because remember, when the volatility expands, your broker will need more and more money to be allocated as a buying power to allow you to hold that trade. So if you did not have a cash, you would be receiving a margin call from your broker. Secondly, because the volatility was through the roof, there was an opportunity maybe to put some new trades. But if you're already maximized, if every money was already allocated, you just lost that opportunity. So it is important to keep cash on hand. So overall, the allocation of money in trades should not be more than 50% or max 60%. Conservatively, I would say stay at 50%. So these were the three lessons that a lot of people would have learned for the first time. Now, do I think that we have seen the worst yet? I don't know. We'll see on Monday how markets behave. I mean, there's still a lot of uncertainty around how coronavirus is gonna end or how long it's gonna go. Nobody knows. But being an option trader, we do have strategies, we do have tools in our toolbox to play in any type of market, and we will continue to be active in the market for the next week. Okay, so that was my thought of the week. Like I said, if you really want to get into more details of this, hop on over to the YouTube video, which is provided, the link is provided here, and I've explained it in a lot more detail. All right, moving on to our next section is our trades leaderboard. So as always, we'll first talk about the profitable trades. So the top one that turned out to be profitable was my put in Tesla. If you have been following me, you know that generally I do not buy put, but the way we saw Tesla made moves a few weeks ago, all the way up to $960, that's also not a general scenario. So I took a gamble. I mean, probably in my option trading career, this may be like less than 0.5% of my trades in which I will buy options. But this one was one of that. The Tesla, I actually bought 2 puts in Tesla at different strike prices. So we had a put in Tesla at a strike price of 500, and the option expires in May 2020, 15th May. But because of the carnage that we saw in market last week, the put was making almost 100% plus. So I just closed it because it was a lottery ticket to begin with anyway. And once I almost doubled the money, I just closed the put. So it was a good handsome profit of almost $1,600 on it. This was a low probability, a gamble trade. It paid off. Doesn't mean that it's going to work always. So second most profitable trades was our VIX hedge. We had put this hedge long ago in November 2019, because at that time volatility was very less, and I had started to hedge my portfolio by buying long calls on a VIX. Those were very cheap calls, and because of the market downturn last week, many of them became profitable, and I closed my March VIX calls. So we had a 3 contract of VIX expiring 18th March and at a strike price of 35. We had bought it at 55 cents, and we were able to close all those contracts at $2.50, giving us a decent profit of $585. Lastly, the third one is again a put on Tesla. I had bought a put on Tesla at a strike price of 620 with an expiration of 20th March. I had bought 1 contract and I closed it at almost 100% profit. Bought it for $4.50 and I closed it at $9. When I initiated the trade, Tesla was trading at $911, and I closed it when the Tesla was trading at $829. So our put was hit the profit target and was auto closed on 24th of February. So these were the three top profitable trades. Now let's look at the trades that did not go our way. So the first one is PagerDuty. Again, this did not go our way in this expiration because I have rolled it out to April expiration. So I had sold 4 contracts of PagerDuty at a strike price of $22.50 and had collected $1.45 in a premium. Because of the weakness in tech sector, PagerDuty had fallen down, and like I said, it's time to roll all our March expiration to April. On 27th of February, I rolled all the 4 contracts from March to April, giving us additional days to be right. When we did the trade, PagerDuty was trading at $18.80, so it was way in the money, but I was able to roll it out for profit. So I had to close the March trade, and we opened up an April trade. When we closed the March trade, I had to temporarily right now book a loss, but I gathered more premium, hoping, once this whole coronavirus things settle down, PagerDuty will go back up and I'll be able to make more money than what I lost in this trade to make sure that overall we come out positive on PagerDuty. Second one is around the Twitter. We had a short put on Twitter at a strike price of $36. We had sold 2 contracts of it, and Twitter had fallen to $32.42. And then I rolled out this trade again from March to April expiration. Similar story as of PagerDuty. Had to book a temporary loss because I had to close the March trade. Took a loss of $700, but I've rolled it out to April expiration. Got a little more credit, and we'll see how things go in April. Right. Lastly is same thing of again rolling out the trade on Canopy Growth. I had 4 contracts in which I had sold a $20 strike price put on Canopy Growth. When it fell down to $18.30 on 27th, I actually rolled out all the 4 contracts from March to April, collected more premium, got more time to be right, and we'll see what happens in April. Okay, so these were the top 3 losses, and because all of them are rolls, I would consider them as a temporary loss for now, and we'll see. Hopefully we will be able to convert all of them into profitable. If not, at least we have reduced our risk because we collected more premium. All right, moving on, let's talk about the new trades that we put on. The top one is the PagerDuty rolled trade that we just talked about. So we have rolled this trade from March to April expiry, collected additional premium. So when we collected additional premium, the overall premium in this trade that we collected is $4.35. But if I add the loss that we had seen because of the roll, net, I have collected $1.70 as a premium. So if you see my initial trade, we had collected $1.45 as a premium. When I rolled it out, I collected additional 25 cents as a premium. So we have widened the break even on our PagerDuty trade. So the short put is at $22.50 and our break even is $1.70 below it. Second one where we collected the maximum premium is again the rolled trade of Canopy Growth that we just talked about. We've collected $14. We sold 4 contracts, each at $3.55. But if I account for the loss, the temporary loss that we have taken, because of roll. The overall credit that we have taken on this trade is $2.16. $2.16 of credit on a $20 strike price is more than 10%, which I think is a pretty good deal, and I'm okay to hold canopy growth. I'm long-term bullish on that one. Lastly is an iron fly that we opened on S&P 500 ETF SPY. The volatility was through the roof, and I did an opportunistic trade to open up an iron butterfly, and we collected huge premium of $11.83 for a $15 wide iron fly. Means when we opened the trade on 24th, our maximum risk in this trade was approximately $317 because we collected huge premium of $11.83. But at that time I didn't know that the carnage in the market will continue. So that's exactly happened. S&P 500 kept going down, down, down. So I also did another hedge trade which I initiated on 27th. So on 27th, I actually went inverted. I rolled down my 221 call to 315 call. So now we have 315 and 330 call spread. Basically, I rolled down the complete call spread from 221 336 to 315 330, and we collected additional credit of $1.60. Remember, our initial credit was $11.83. We got another $1.60. That means our total credit in this trade is $13.43 on a $15 wide spread. So even if we have to close this trade at a loss, we will be incurring about $157 loss. So we already reduced the loss from $317 to $157. But if S&P 500 rallies a bit and comes back into our profitable zone, we can close it at a profit. Right now we are inverted by $6, means this trade will trade minimum at $6, but we have collected more than $13. So even it comes out to and stays between the short strikes, we'll still make $700 on it. So this was a new trade that we initiated, and also we had to do a quick adjustment. Like I talked about, I did a lot of adjustments last week, but this one was a quick adjustment that we had to do on our S&P 500 trade. Okay, so I think this brings to the end of our trade leaderboard section. It's a time to move on to the next section where we answer listener and viewer questions, mailbag segment. All right, so the question today for a mailbag segment is when and how to manage short strangle position. This was again a question posed to me at Quora, and let me quickly get through it in terms of how we should approach of managing a strangle position. So just to quick recap, strangle means you have a short put and you have a short call, and the stock is trading in between your short put and short call. Now, first question is, when should we manage it? So to manage it, you will start managing it if the stock has crossed your short strike, either the put side or on the call side. That is one condition on which you will start your management. Second condition on which you will start your management is if it's approaching 21 days to expiration and the trade is still not profitable. In that case also you will start to manage it. So these are the two conditions that I follow in terms of when to start managing a strangle. Now let's talk about how to manage a strangle. So first thing first, if you still have more than 21 days to expiration in your trade and the stock has already crossed your short strike, means it is time to manage. But now the way to manage it is you roll down or you roll up your untested side. Means if it has crossed your short put side, you roll down your call side to reduce your delta. If it has crossed your short call side, you roll up your put side to increase your deltas a bit. Okay. So this is how you manage a triangle if it is still more than 21 days to expiration. If it is already less than 21 days to expiration, the best management technique is you move out the whole trade. You roll out the whole trade from a current expiration month to a later dated expiration month. Do it for a credit so that even if the stock doesn't cooperate and you have to close it for a loss, you will close it at a lesser loss because you took more credit. If you want to recenter the trade, you could do it. You could change the strikes, but generally, if I have the same outlook on the stock as I had when I initially put in the trade, then I will not recenter the trade. But that's essentially how you manage a trade. Either you roll up or you roll down your untested side. The second way to manage it, you roll out from the current expiration month to a next expiration month. All right. So if you want to know a little more about trade management, I have done a whole series of option trade management. Go to my YouTube channel, OptionGig, and search for option trade management. There are, I think, 4 different techniques we talked about for different type of trades. In this question, it was only for a triangle. That's why I am only talked about triangle in this. But in those series of option trade management videos, I've also talked about how to manage defined risk, how to manage undefined risk, and things like that. So you can go hop on over to YouTube channel OptionGig, and you can watch more videos on how to manage different types of trades, and then also a little more detail on when to manage. Okay. All right. I hope this helps you. And this brings us to the end of this week update. I know everyone is eagerly waiting for what's going to happen in the next week. I don't know what's going to happen, so we'll watch tomorrow in terms of how the market's looking like. The futures right now are all up, but we don't know what news fairy might bring us in the morning, and we'll see what happens in morning. Again, I do have kept some cash aside, and we find some opportunistic trade. I will be willing to put on those trades, and hopefully if those trades make onto the trade leaderboard, I'll share it with you at the end of next week. Thank you very much. Have a wonderful day. Happy trading. Please note that all the information presented is purely for educational purposes and is not a financial or investment advice. I don't know you, you don't know me, so do yourself a favor and don't invest or trade solely based on what you hear.